Hi, good evening, everyone. Very welcome to the second webinar from our series of webinar we are holding in Malta in collaboration with Malta Association of Compliance Officers and MFSA. So thank you very much for joining us today. My name is Aamar Ahmad. Myself, I am actually the Managing Director of Sigma Risk, and we are working with a number of institutions in Malta. So we will talk a little bit more about ourselves. So let me quickly introduce our panel members. So today we have Kurt Lucas from MFSA. Kurt is the senior analyst in the Financial Crime Compliance Department at MFSA. We have Eric Micallef as well from MFSA. He's an analyst in the Financial Crime Compliance Department. Also, we have the honor to have Stefan Berry today, who is the president of Malta Association of Compliance Officers, MACO. So very welcome to our panel members, as well as very warm welcome to all of our delegates today. Let me briefly explain what we are expecting today. The session today, we expecting it to run for around an hour and 15 to an hour and 30 minutes maximum. I would say 75 to 90 minutes maximum. So the idea is that we will have 3 presentations today, all on the topic, a very hot topic of Client AML Risk Assessment, CRA. The first presentation is going to be delivered by MFSA. So they will present the regulator view and regulators' expectations and how do they give importance to CRA and how do they look as to what an CRA should look like from Malta perspective. Then we will have another presentation by Stefan Berry, who will bring a perspective from the industry. Stefan is the president of the Malta Association of Compliance Officers. He works very closely with the industry from the compliance officers from all over the Malta, and he is very much aware of the challenges that you guys face at your workplaces, the opportunities. He is very much aware on the best practices or the possible solutions of the challenges that we face in the Malta. So that will be a very interesting presentation from Stefan. Then there will be third presentation from myself, and I will focus mainly on how does an effective risk rating methodology looks like. Why is it important to have a client risk assessment tool or methodology? And I will give a little bit more on the global perspective, being myself having the experience and exposure in working with a number of institutions all over the world. So that will be a third presentation. Each presentation will be around 15 minutes long. And once we've done with the presentations, we will then go through a demo of a risk rating methodology that will give you some idea as to if you want to build a methodology at your workplace, or if you already have a methodology at your workplace, but you want to have some fresh perspective, some fresh idea, then there is going to be a demo from myself, which I will present, that will is our effort to share with you our expertise as to what we have produced over the time and what are the things, how different organizations build their risk rating methodologies, what are the key features they make sure that a part and parcel of an effective risk rating methodology. So that is all from my side in terms of the introduction. So thank you very much, all of us, once again. So what we're going to do before we actually move into the presentations, some house rules. One, please, may I request all of you to please stay mute during the presentations. We will have a dedicated Q&A session at the end. So if you have any question that you want to ask to MFSA, to MACO, to myself from Sigma Risk, please feel free to post your question in the chat function. And at the end, we will try our best to answer the question that you may have. If we could find the answer now, we will provide the answer now. If we couldn't find the answer, then we will share later on after finding out an answer for you. Okay, so thank you very much. Now what we're going to do before we move on to the presentation, I have just a couple of questions that I wanted to ask the members as part of a poll. So is the first poll I'm going to actually launch right now. If you can please, it should be visible on your screen now. So do you use an automated client risk assessment tool at work? So the question is automated. So I understand a number of institutions use either a poll through like an Excel sheet or on a piece of paper or some kind of document, but we're talking about automated, something that is in a live environment. Okay, I will give it maybe another few minutes, a few seconds. So maybe another 10 seconds. Okay, that's perfectly fine. So what I'm going to do now, I'm going to end the poll now, and we will share the results with all of you. So now you can see that actually more than 50%, nearly 60% of you actually do not have an automated client risk rating methodology as of now. And great to know that there are at least 41% where you do have a risk rating methodology. So that is a thank you for actually answering this particular poll. So there's another poll which I'm going to launch right now. So 1 second. Okay, so the next poll should be on the screen as well. Is your client risk assessment tool, is it built in-house or it has been developed by a third party? So I understand not all of you have it automated one anyway, but even if you have it, then whether it is in-house or from a third party, that was going to give us a good understanding as to what is the common practice within the industry in Malta. Okay, that's fine. I will give it another 5 seconds and then we will move on and we will share the results. Brilliant. So now I'm sharing the results actually on the screen. You can see that majority of you, at least 2/3, 62%, you have the tool that you use actually built in-house, and around 1/3 you're using a poll from using a tool which has been developed by a third party. Thank you. So the last question on our pollings is going to be launched right now. There you go. It should be on your screen now. So what do you think? What are the main challenges that you face at your organization from CRA perspective? Do you have lack of technological resources, lack of budget, lack of skilled staff, or is it difficult for you to convince your senior management that, hey, it is important. We need to have a risk rating methodology. We need to have automation. We need to kind of spend. So what is the thing that you think is the most I would say important challenge that you face at your workplace? So these are all anonymous, so we will never know who has answered what. So please be as honest and transparent as you can. So it gives us a very good understanding from the industry perspective. Okay, I will give it another 5 seconds and then we will close this poll. All right, okay, let me share the results now. So the large proportion, 44%, nearly half, is due to the lack of technological resources that you have. Lack of skilled staff, still 1/4. The third biggest category is the lack of support from the senior management. And actually, I'm quite surprised, and I would say I'm actually pleasantly surprised that the lowest proportion that actually goes to the lack of budget, which is a really good thing, that at least there is not a problem which we see a lot when we ask similar questions around the world, The lack of budget mostly comes up as the most kind of important factor. But here, which is good to know, that budget is not a problem. It's mostly the skills. Either you don't have a skilled staff to build it yourself, or you do not have the sufficient technological resources. You don't have the system which you can automate, for example. To me, that's what it looks like. So thank you very much. So that's great. So we are actually done with the polls. So thank you very much for taking part in the polls. So now we are going to move on to the first part of our presentation. So I would request Kurt and Eric to share your views from MFSA perspective. And then after that, if anyone got a question from Kurt or Eric, please feel free to place these questions into the chat function, and then we will answer the questions at the end as well. So Kurt and Eric, over to you.
Thank you, Aamar. I'm going to start sharing my presentation just in a moment, please. Okay. And can you just confirm that everything's visible okay?
Yep, perfectly fine.
Thanks a lot, Aamar. So, good evening, everyone, and thank you again for registering for this webinar in conjunction with Sigma Risk. Thank you, Aamar. And as Aamar already explained, I'm Eric Micallef. I'm joined today by my colleague, Mr. Kurt Lucas, and we will be representing the MFSA's Financial Crime Compliance function today. Now, our presentation will it will obviously revolve around the customer risk assessment. However, it will base itself mostly on the regulatory background, the local regulatory background, which is obviously fundamental to our expectations as a regulator. Now, on your screens, you can see the topics that we'll touch upon today, and these basically revolve around the defining the CRA itself, as well as its scope, the regulatory obligations that emanate from the customer risk assessment, who can perform the CRA and the record-keeping obligations, the main risk pillars of the customer risk assessment, alongside the risk factors and their specific weightings and ratings, the CRA, a typical CRA process, and the final risk rating that should be concluded from it. And we'll have some concluding remarks to end our part of this webinar. So let's start front and foremost with defining what a customer risk assessment actually is. And this emanates from section 3.5 of the FIU implementing procedures, the IPs, where they define a customer risk assessment as being an assessment that is carried out by a particular subject person, and obviously by any subject person at that, on the specific risks that it is exposed through carrying out and providing its services to specific types of customers, which customers are themselves linked to particular jurisdictions through perhaps one or more channels. Now, this is where we touch upon the obligation of basically having each subject person carrying out a customer risk assessment prior to establishing a business relationship or even carrying out an occasional transaction. So this is the first obligation, and I think the most apparent. And obviously, the conduct of a customer risk assessment will then ultimately inform the subject person in formulating a specific customer's risk profile. Now, basically, understanding what a customer risk assessment actually is will help us actually appreciate what its conduct is meant to achieve. Now, obviously, the most obvious one is identifying and assessing all the potential money laundering and terrorist financing risks that are linked to carrying out a certain business relationship or occasional transaction. However, fundamental to the CRA is that it should also dictate the level of customer due diligence that should be carried out on that specific customer, as well as the frequency on reviews, be it either ongoing monitoring and even reviews on that particular customer risk assessment carried out on that specific business relationship or occasional transaction. Now, although this is fundamental, there are other inputs that the customer risk assessment should be a part of, and that is especially in accordance to educating the holistic business risk assessment. Obviously, the customer risk assessment will give a specific outlook on the exact type of customers that a subject person is encountering, and this will help the business risk assessment be more specific and cater to the exact position of that subject person. This will ultimately impact the risk appetite emanating from that business risk assessment, which is itself a live document and which should be revised during the life cycle of that subject person. And it will ultimately affect the customer acceptance policy, which itself is linked to the customer risk assessment in a full circle, basically. Now, as we said earlier, the regulatory obligation for the conduct of the CRA arises from Section 3.5 of the IPs. However, the IPs revolves around what we know as the prevention of money laundering and financing of terrorism regulations, otherwise known as the PMLFTR. Now, every SP from this obligation, basically every SP is obliged to carry out and take proportionate steps according to their size and nature of their business, and basically identify and assess the risks, the money laundering and financing of terrorism risks that arise out of their business and out of the customers that they encounter throughout carrying out their products. So the next question arises from who can perform the CRA. Now, obviously, each subject person is obliged to carry out the CRA. However, you as subject persons can employ external consultants, and we acknowledge how employing such external consultants and their products, which may be software solution or specific IT tools, they can give a certain peace of mind. However, it's important for subject persons to remain aware and knowledgeable on the CRA methodology employed. So if a subject person encounters a client and its final risk rating is not commensurate to the actual risk, that subject person is able to identify that problem. And as a best practice, subject persons should follow the 3 lines of defense principle to basically ensure independent oversight over the entire process. I'm going to give the floor to Kurt now to carry on with the rest of our presentation. Apologies, apologies. I still had a slide left. I'll take care of it, Kurt. The last slide from my end is in relation to record keeping of the CRA, and it's basically the obligation for subject persons to document any changes that occur that they implement to their CRA methodology. This is important, obviously, so there's always a track record of any changes in risk weightings, or rather the allocation of risk weightings, and it's important, as obliged by the IPs and the PMLFTR, that you as subject persons basically document any changes that your CRA encounters.
So, thanks a lot, Eric. I will be going into more detail over the typical risk pillars that form a good customer risk assessment. So first and foremost, the product risk, product, service, or transaction risk. The FIU implementing procedures definition is simply the risk associated with the selling and transferring of a product or service to a customer in a business relationship. However, this risk depends on three main factors: the transparency, the complexity, and the value of size. When we say transparency, it's what level of transparency, what degree of transparency does the product facilitate. For example, products or services that inherently provide or facilitate anonymity and are considered, therefore, to present a higher money laundering and financing of terrorism risk, like nominee accounts or fiduciary and trustee services. Some questions that you might need to ask are: did the client understand whether this product is transparent enough or otherwise, or is the customer after products or services that facilitate anonymity and thus allowing the customer to hide his identity? Here one must also take into consideration whether instructions can be given only by the customer or there are some intermediaries as well. Regarding complexity, it is the degree of complexity offered by the product. It's the risk of a product or service is conditioned basically by the complexity of the transactions that can be carried out by making use of the same product. For example, trade finance. And typical questions here are: did the client understand the complexity of the product? Is the client involved in multiple parties, in multiple jurisdictions? We mentioned trade finance products. Trade finance products typically involve multiple counterparties with transactions crossing multiple jurisdictions in large values. The value and size of the product. Basically, the value of and size is whether the product is, for example, cash intensive or allow high values transaction. And questions asked are: did the client understand what the volumes and sizes of the transactions are? Is the client after a product which allows a high value transactions? Is the client after a product or service which involve cash transactions? Usually, the information found in the CRA in relation to the product in question is minimal, as the response from a subject person during supervisory engagements would be that the product is what it is, and the customer's knowledge of the product is confirmed as the customer itself signed the application forms, including disclaimers. Firms, in this case, subject persons may also reduce some of these risks by carrying out a CRA or perform CDD if there are counterparties especially involved. They perform a CRA and perform a CDD on the counterparties in question. Moving on to the next slide, the customer risk, basically. The definition in the implementing procedures is the risk arising from entering into a business relationship with a particular customer. Here, usually the information found in the CRA in relation to customer relates to the employment or business activity of the customer and maybe the PEP status of the customer. But careful attention to the customer's others activities must be given. Here we are seeing a list, a non-exhaustive list of certain activities which are linked to the customer risk, to the risk posed by the customer, such as cash-intensive activities, activity commonly associated with a higher risk of corruption, activities posing a higher MLFT risk. Basically, there are a number of activities, And we are seeing that the risk of the MLFT risk may vary in accordance with the type of the customer and the type of activity. So basically, in determining the risk that a customer poses, subject persons should also be aware of the customer's behavior. The more information in relation to the customer and its activities one obtains, the better. And therefore, the clearer the picture will be when assessing the customer risk of a particular relationship. In other words, we are talking about the information obtained in the client profile, which goes hand in hand with the customer risk assessment. The information basically needs to be not we go overboard with the information obtained. We need to obtain the necessary information and not more, not less, basically. Moving on to the next, basically, risk pillar is the geographical risk. Basically, the definition in the implementing procedures is the risk arising from the locations where the customer or its beneficial owner are based and where the customer have relevant personal risks. So basically, we can segregate the jurisdictions involved in a business relationship into three. First, the first pillar, I'd like to call them the three pillars of geographical risk. The first pillar is the jurisdictional background of the client. So, for example, the nationality, domiciliation in case of corporate clients, residence, and the principal place of business in relation to corporate clients, and the jurisdictions with relevant personal links in case of individual clients. The second pillar are the jurisdictions from where the source of wealth and source of fund have been built. So basically, here we are saying if, for example, an individual customer is applying to open a business relationship with yourselves, basically, you must understand if, for example, he's a foreigner living here in Malta, in which jurisdiction he built his source of wealth and source of funds, and that jurisdiction must also be taken into consideration for the geographical risk. The third pillar is the jurisdictions with which there are either financial connections in case of individual customers, or trading activity is done in relation to corporate customers. So basically, for example, if there's a corporate customer which is applying to open a business relationship, and this is a trading company, you must understand with which countries, with which jurisdictions the corporate customer is doing its trading activity. Or, for example, if there's an individual customer, maybe he can provide information on any financial links to other jurisdictions. Maybe he has some investments abroad as well. So these are all these jurisdictions, these three pillars must be taken into consideration when assessing the geographical risk of in a CRA. Moving on to the interface risk, the delivery channel risk. The definition in the implementing procedures is the risk arising from the methods used to establish the business relationship. So basically here we are talking about face-to-face versus non-face-to-face. Whereas the face-to-face offers a lower degree of MLFT risk, since the subject person is interacting directly with the customer and thus ascertain the true identity of the customer itself, non-face-to-face business relationships actually offer a higher degree of MLFT risk, since the subject person might be interacting with an individual which is portraying a different identity. Even though checks and balances might be in place to mitigate such risk, the implementing procedures imply that such relationships might still need to be considered as posing higher degree risk when we're speaking about non-face-to-face. The implementing procedures also give some examples. For example, relationships whereby a number of intermediaries are involved in the servicing of the business relationships, or relationships whereby the customer is introduced by an introducer on which reliance is placed, and the subject person's relationships and or transactions which are internet-based, for example. One aspect to note is that if a subject person onboards relationships which are introduced to a multiple layers of intermediaries, introducers, call them what you want, then the reliability of these intermediaries vis-a-vis AML CFT standards must also be taken into consideration. So, moving on to the next slide, we spoke about the 4 main risk pillars. However, a customer risk assessment is not only limited to those 4 main pillars. Additional risk pillars, risk factors, can also be included. For example, the reputational risk, which is also defined and described in detail in the FIU implementing procedures, which is the risk arising from reliable adverse information on the client, other information from official data sources such as registries, and information on regulatory action taken in terms of, for example, licensed entities which are applying for a business relationship with yourselves. There is also the nature and behavior, which is the risk arising from hesitant interaction by the customer or beneficial owner. In the slide, there are a number of hesitant behaviors, let's call them that way. For example, reluctancy in providing the documentation, or doubts in the documentation's authenticity, etc. So these must also be taken into consideration. There are also there can be also taken into consideration some sector-specific risks. Sector-specific risk factors arising from the specific relevant financial business or relevant activity that you are undertaking. Sector-specific risks are also described in details in the FIU sectoral implementing procedures, so the Part 2s. And there are also sector-specific risk factors which are highlighted in the risk factor guidelines issued by the European supervisory authorities. It's a document dated for January 2018. Other factors which are not specific to the given business relationship or occasional transactions, given that the subject person deems that they can sort of manifest themselves throughout the business relationship, must also be taken into consideration for CRA purposes. So we discussed the 4 risk pillars, additional risk factors. Now we will move to an important topic within a CRA. It is the weighting and the rating of risk factors. So basically, the implementing procedure, section 3.5.3, discusses the relevance of or weight of a risk factor. And it states an effective CRA is only possible if the methodology applied allows for sufficient flexibility to take into account the particular circumstances of each case. So basically what we're saying is that besides rating each risk factors, there must also be a weighting applied to each pillar. For example, the customer risk or jurisdictional risk, I might tend to say that it has a lot more weighting on the customer risk assessment than, for example, the interface risk, because the background of the customer, the jurisdictional links of a customer bear more weight than whether the customer is opening the business relationship on a face-to-face or non-face-to-face basis. So basically, weighting must also be included rather than only rating the risk factors. Some basic principles to which a respective weighting methodology must adhere, however, is that, for example, weighting must not be influenced by just one factor, and that the ratings are not to be influenced by monetary or business considerations. And also that the weighting is not to be overruled by the provisions of the PMLFTR on situations that always present money laundering or financial terrorism risk. This is discussed more in detail in the implementing procedures. One important principle here is that the weighting needs to be done. Actually needs to be done in a manner that it does not lead to a situation where it is impossible for high risk rating to be achieved. Unfortunately, in our supervisory interactions, we encountered situations where the customer risk assessment, even if you risk risk factors on a high risk degree, the ultimate high risk rating couldn't be achieved because obviously of the methodology and the weighting. So basically these are minimum basic principles which one needs to keep in mind when designing the weighting methodology to be implemented in a CRA. A typical CRA process, moving on to the next slide, is where you have the 4 risk pillars and the additional risk factors which we discussed earlier, and they are all put together in an algorithm basically, and which algorithm will give you a risk rating. However, there is the manual intervention, and this is something that it is important to be highlighted as well. Manual intervention by the MLRO is important because even though the risk factors included are accurately inputted, and even though the weighting, the methodology is accurate as possible, and the MLRO has that gut feeling that the risk rating, the resulting risk rating, does not justify the level of risk posed by the customer, basically the manual override will give the MLRO the possibility to alter the risk rating, to alter basically the risk rating so that he is satisfied after all. And this is also a requirement in the implementing procedures, and this is something that promotes also good governance and a good CRA basically.
Kurt, you got 1 more minute.
Yes, this is my final slide basically about the risk ratings. The minimum standard is having a low, medium, and high risk. However, it is permissible also to have the in-between categories, like the medium low and medium high. And if there are potential categories which pose a different degree of high risk, you can also, rather than stick at high risk, even include a very high risk or extreme risk categories. So basically these are all permissible, and at times we found them out. So concluding remarks, a sound CRA is one which takes into consideration the maximum number of risk factors that in some way or another pose a degree of MLFT risk to a customer or business relationship. Therefore, the more information collected and assessed in a CRA, the better and more effective the CRA is. And that's all from my end, Aamar. That's all. If there are any questions, you can post them on the chat and we'll be happy to reply.
Thank you, Kurt and Eric. It is a really good, really comprehensive presentation on behalf of MFSA. Just a couple of key points as a summary here, I would say. Thank you for highlighting that. It's nice to have a methodology in place. You might want to build it in-house or maybe get it from the third party, but at the end of the day, the responsibility is with the subject person. They are obliged to make sure whatever they have, it works, it suits their risk appetite, it suits their business profile, it suits the compliance for their very own regulatory requirements. Kurt, you mentioned as well, is very important to look after the product risk as well. Each product carry different type of risk, so due to different factors. So that is another important risk factor that you've highlighted. And also geographical risk. We were going to talk a little bit more about the geographical risk as well. So that is something that we will talk in further detail. So thank you very much, Kurt and Eric, for your
You're
presentation.
welcome.
Thank you. So Stefan, over to you to present the opinion from the industry representative, the president of Malta Association of Compliance Officers. Stefan, if you can keep it within our 15 minutes, that will be fantastic.
All right, thank you, Aamar. Let me just share my screen. 1 second. Can you see my presentation?
Yeah, we can.
All right. Okay. Thank you very much. So let's kick off with the main concepts. As already mentioned also by Eric, the CRA must not be seen in a silo. It needs to interact. It needs to be in a symbiosis with other important documents. I would say in this slide, the other most important document would have to be the business risk assessment. You cannot have the business risk assessment and the CRA working, living separately. They need to live one next to the other. They need to be in symbiosis. And this is a point I would like to raise also for those of us who are engaging third parties. We have situations where we engage a third party for a BRA and we engage another third party for the CRA, and the two do not communicate between them. This obviously results in a bad result, in a bad document, both for the BRA and the CRA. So if you're going to engage different people, even different groups within your organization, make sure that they do talk between them and that they do communicate and work on the same documentations, because these documents need to dynamically interact between them. Looking at it from the legal perspective, what is expected of us, as Eric already highlighted, there is the law, there are the regulations, there is obviously also the implementing procedures, but already from the implementing procedures, we can pinpoint a number of obligations which we have and which are posed upon us. Once again, we need to make sure that our CRA talks the same language as the BRA and vice versa. So we cannot permit ourselves to have different documents talking different languages. I would dare also here draw a distinction between the customer risk in the BRA, where we're looking at the customer holistically as a group or as various groups, depending on who we are, what we do as organizations. Always bear in mind that by subject persons here, we're looking at different industries. So it's across different industries. It's also across different sectors. So we could have a small organization with just 2 people. We could have a larger organization with almost 1,000 people. So we need obviously to be proportionate in how we approach it. But there is customer risk and obviously the assessment of it in the BRA. And we also draw a distinction from the customer risk assessment per se, which is a different exercise, if you like, and it's a more detailed exercise and which we need to run with each of our customers. What is being expected of us? 2 things in a nutshell. We need to assess, and by assessing, we need to put in, as Kurt mentioned, all the risk factors we manage to find, all the risk factors we manage to categorize. There could be risk factors and there could be sub risk factors per category. So they could also dovetail into different subcategories, if you like. And we need to risk assess. So this is not just a question of, yes, this is our risk. We put a lot of narrative and we stop there. Somehow we need to give a figure. Somehow we need to give an idea. And shortly we'll see why this is needed. We need to remain vigilant. So once again, we're talking about the CRA. We need to have it at the beginning, yes, but the CRA is a live document, just as the BRA is a live document. So we're not going to do this risk assessment once and then forget all about it, shelve it, put it away and that's it. No, the CRA is a document which we need to revisit from time to time, periodically, depending on certain triggers as well. So this is something which we need to bear in mind and which we need to remind ourselves as well. So the CRA is a live document which we definitely need to revisit from time to time. Yes, we need to put in as many risk factors as possible. Kurt mentioned the most important, the ones which we have also contained in our procedures, but there could be others. Make sure that as much as possible, depending on who you are, depending on your industry, depending on your sector in the industry, you make it sensitive to what you are actually doing. So somehow, whoever is reading your CRA, whoever is going through your CRA needs to feel that, yes, we are talking about this particular sector. Do not obviously just copy and paste any model which comes handy and say, okay, this is mine. But then you realize that it's not yours, it's not relevant to what you are doing, to who you are. Two important points which have already been picked on are reputation and behavior. And this is something which we will revisit again. Why? Because we will be seeing that as time goes by, and then also in new models, when it comes to new models with the CRA, behavior here is split into two. Transactions, what transactions are going, if any transactions are going through our system, pertinent to those customers, pertinent to that particular customer, but also the customer screening. So these two elements of behavior, the screening and the transactions, the behavior, need to somehow remain relevant and feed and ping into our CRA, I would say almost every day. Almost every time there is an activity going on. Why? Because ultimately, the CRA is not just in vacuum, it's not just an exercise we do, happy and done. No, the CRA is ultimately part of a larger umbrella called Know Your Customer, and Know Your Customer in the widest sense. In the widest sense. So we need to be happy that we know who our customer is, not just for the purposes of the law, the regulations, the IPs, but throughout. What are they doing? Why are they here? Why are they using my products, my services? Why have they chosen me, not my competitor, for example? That is all part of the wider umbrella called KYC. Okay, yes, another point. We don't have, and the law tries to make it clear, very clear, in fact, that when it comes to the methodology, there isn't one preferred methodology. The law is neutral when it comes to methodology. And this is obviously of help as well. Why? Because I cannot impose a method on an organization which is very small, and therefore impose a methodology which is overboard, which is too much. So methodology needs to go hand in hand with proportionality. That is definitely the case. Likewise, we don't actually have methodologies when it comes to our BRA, but we know that it has to be something relevant to who we are, what we do, and it needs to be proportionate as well to our existence, to our activity. Yes, when it comes to the CRA, therefore, we need to have a good balance between the narrative and the numbers and the figures. So we need to have a good balance between the qualitative and the quantitative. Obviously, trying to balance out the two, it's useless going too much one way or too much the other way. We need to have a good idea of what is being understood in our respective models, however we have modeled them or prefer them to be. A few points which are worth mentioning. EBA, the European Banking Authority, I know that it does not apply necessarily to all subject persons. It's usually by default applies to credit institutions and financial institutions, but it's worth looking into what the EBA and also the sister entities do produce from time to time. This was already mentioned as a document. It goes into risk factors, it has been updated, and it goes into certain important ideas. So even when, for example, we are dealing with customers coming from a particular industry, it makes sense that we do somehow assess that particular industry to show that we are receptive, we are understanding of that particular industry. Here before me, I have pharmaceutical, for example. What are the perils, especially from a money laundering and terrorist financing point of view, when it comes to the pharmaceutical industry? What are the perils, for example, if my customers are coming from the gaming industry? So do make it relevant to who you are, even though, strictly speaking, if you're looking at the IPs, they don't necessarily mention that particular industry. But if that is your industry, that is where you work, that is where your bread and butter is, make it relevant, make it associate yourself to that particular risk factor. Once again, even these guidelines, even the EBA guidelines, look into reputation, nature, and behavior. So remember, when it comes to behavior, we're looking at the customer screening plus the transaction monitoring as well. So those are two very important points. Another document, this time round, however, it's in consultation. So this is not a final document. This is not a final document. It's a consultation. Consultation will end in November, but it goes into AML CFT compliance officers, what we would translate naturally into our MLROs, for example. Here too, we find certain obligations which touch upon also our methods, our methodologies, how we risk assess both the business, therefore business-wide, and the individuals, therefore customer-wide. So these are this is a consultation document that's still yet to be finalized, but even here we have a pointer that BRA, CRA are here to stay. So this is a further layer provided by DEBA. So it's not something which is just local, it's something over and above, if you like. We also need to make sure that we don't just limit ourselves, as I mentioned in the first slide, to the BRA, the CRA. We need also to look into our other documentation, our policies, which are set at board level, our procedures, which are set at the management level, and the applicable controls. So those all need to be talking, we need to be all on the same line and be consonant one with the other. Another important document, this is obviously also very recent, is the AML package issued by the EU, this time by the EU Commission. So here we have literally the AMLR #1. Because a regulation now is being proposed in terms of AML CFT. So we're no longer talking just about the directive, now we're talking actually about a regulation. And even in the regulation, bear in mind this is still a proposal, so it's not yet finalized. Even in this regulation, we have that we need to do individual analysis. So even in the new law yet to come, we do have the commitment and the requirement to have and to perform our customer risk assessment. So this is just to give you a taste of yet to come, of the future, where we still need to ensure that all these are taking place, even as was mentioned earlier, when we are outsourcing. And this is very important. We tend to rely a bit too much on the outsourced entity. Why? Because sometimes we engage audit firm A or law firm B, and we say, okay, they're good, they do it all. No, but make sure that what they are doing is relevant to what you are actually doing. Because sometimes we tend also to have buying documents which do not actually belong to us. So we end up paying a lot for something which is, at the end of the day, partly irrelevant to who we are and what we are doing. So this is another important point. Now, I tried to run through a sort of mini exercise, if you like. Now, this is an example. It is not really a fully fledged CRA, but it's just an example, just to give pointers, ideas, as to what we need to include in our model, in our respective model. Now, bear in mind, everyone needs to have his or her own respective model. I cannot just impose a model on someone because it might not be relevant to that someone. But there are pointers. So we mentioned we need to have customer details, we need to have the date, so it needs to be dated as well. It's obvious, but not so obvious to everyone. The risk factors. Now, the risk factors, ideally, and this is true practice here, ideally the risk factors need to be subdivided. So if we have, for example, here, we're looking at the customer risk. Customer risk can be divided into residence, the source of wealth of the customer, the business activity of the customer, whether the customer is a legal entity or an individual. So it's not just customer and I give a quantitative number and I'm done. No, make sure that it is relevant to your activity. Likewise, if we're talking about the product, what product or service I am selling to the customer. The ticket size, so the amount per transaction, is split into 4 categories here. Obviously, each category would reflect a different risk weight, a different risk scenario. In this particular case, the customer will have 4 different levels. So if we're talking up to 5,000 euro, then that would be considered or deemed to be a low risk. Why is it important to, as much as possible, give ideas, give understandings? Because whoever is inputting, whoever is conducting and using the model of the CRA needs to be guided and understand where we are going with the exercise. Do not presume that just because you as MLRO or you as head of operations understand the model, then everyone in your organization understands the model. The model needs to be simple enough, straightforward if you like, that even your onboarding officer or your onboarding executive, whatever we want to call the person, understands and has his or her life made easy. Okay, obviously as MLROs we want to avoid 1,000 calls every day because the model is misunderstood internally. So the model itself, the more it gives ideas, the more it gives easy categorization, the better it is also internally because things move more smoothly. Okay. Likewise, with the other risk factors, we can open geography if you like, just as Kurt did. Kurt opened geography into 3 pillars. That is ideal. Yes, open it into 4 pillars if you like as well. Explain why, where are we, and give ideas. The idea here in these 4 columns is you're giving actual ideas. So if a residence is EU-based, EEA-based, then as a presumption, that is going to be low risk. If, on the other hand, the individual, the prospective customer will tell me, okay, I live and I work and I am from North Korea, that in itself is already giving me an idea of extreme risk. Okay, so that is already an idea. Other risk factors, one we didn't mention, adverse media, that too can have relevance depending, once again, on who we are and what we do. A couple of other items I wanted to mention is sanction status. Do I run a sanction check on the name just before even starting my exercise? Is that factored into my CRA or no? In this case, I'm giving the example that if it's going to be a sanctioned person, that will have an override over everything. Because in this case, my appetite is I don't want anyone who is sanctioned on my customer list. So in that case, I'm going to give it an override. What is also good practice, if you like, is that there are entities, there are subject persons who concurrently, whilst having the list to input, are also having an automated tool which still runs the data inputted and comes up with its own weighting. Like that, I am guiding my own people, my own inputter, my own CRA compiler in, okay, the model says this is high risk. Am I on the right track or am I completely doing something as low risk, for example? So having an automated tool integrated or supplementing or complementing my own CRA is an added plus. So this is just ideas. I'm just highlighting here just to give ideas of what should be contained. Obviously, more can be contained, but then again, always bear in mind that the more you're going to go for a complex model, the more you're going to make life impossible for your own people. And therefore, that might not be actually a working model for you. Okay. Now, just to give you a quick idea of how it works out. So
Stefan, sorry, you got 1 more minute.
Okay,
Sorry for reminding you.
It's okay. So this is how it's worked out in this case. In this case, we happen to have someone who is EU based. It's a simple model, so there's low risk, medium risk, it's not sanctioned, and therefore here we're working out automatically. Obviously, it works out the different percentages, and it adds up to a 29%. So this customer is 29% risky, if you like. That would then work out here. It would work out and tell me how much that works out in high, medium, or low risk, or extreme risk, if you like. It links to when my next CRA is due, because the CRA needs to be repeated at least formally every so often. So depending on the risk level here, it will tell me when it's next due. And if someone is, for example, high risk, I would need, for example, the sign off of the CEO. Or if it's going to be extreme risk, I need the sign off of the risk committee, for example. So this is just to give you an idea of where and how we need to link ideas. Best practices, once again, customer screening, transaction monitoring, those are definitely the way forward. We need to include more technology. So we need to somehow sit down with our developers and understand that we need to simplify the architecture. We need to improve the data quality, because the data quality is what we base ourselves on. We need to make sure that automated lives hand in hand, side by side with manual. One does not totally exclude the other. We need to have behavioral metadata inputted, flagging and triggering our CRA, because that will help us long term in the quality of our CRA and the result of our CRA. We need to have machine learning integrated into our CRA. So these are all future looking, what we need to include in our CRA model going forward. I included here a couple of common faults which we find in the CRAs and why people have been penalized in what they have done wrong or left out or missed out upon. And finally, in this slide, I also included something which is a bit of a checklist. If I were an MLRO, if I were a compliance officer / MLRO, I would try to make sure that I run this list at least once every 6 months and make sure that it's relevant. I reply to these and I have a good answer to these, because these are more or less giving us a good idea of where we are with our CRA, model. Okay, so that's it from my end.
Thank you, Stefan. Very, very comprehensive, very knowledgeable. I'm sure all of us, we've learned definitely from what Stefan just shared. So, Stefan, once again, thank you very much for sharing your experience, because you work very closely across the industry in Malta. So now what I will do, I will have a very brief presentation from myself, and then we will have a very brief demo as well, as to share kind of, I would say, a risk assessment model in real life as to how something actually can work. So if someone can please confirm if you can see my screen.
Yes.
Okay, fantastic. Yes. So I will be quite quick. So one thing I will mention that at the end of the day, we will actually share all of the slide decks with all of you. So you will have a good opportunity to read it in thoroughly after you've attended this webinar. About myself, briefly, about Sigma Risk, I know you all know MFSA, you know MACO. Sigma Risk, we are actually a consulting and training firm. We are based in UK, but we do operate literally all over the world. We have offered number of projects with number of institutions all over the world. Even in Malta, we have actually had a really good relationship with MFSA as well, and we have worked with MFSA within from the training perspective, which we offered to the financial crime department of MFSA. Myself, some of you would know me, some of you wouldn't. So myself, I'm actually a fellow member of International Compliance Association, ICA, and I'm actually one of the ICA teacher as well. So I do teach on behalf of ICA, the ICA diploma classes and other specialist certificates as well. So from my perspective, customer risk assessment, I think enough is said. So I'm not going to really repeat what has already been very thoroughly put together by the panel members. So we know we have learned so far what is client risk assessment, customer risk assessment anyway. Why do we need to risk assess our customers? And I will talk a little bit more in about the primary and secondary risk pillars in the coming slides. And why do we need to have a risk rating methodology? Okay, so we will talk about it, and then automation, what the key benefits that automation brings in. So I will spend maybe a couple of minutes on that as well. So a client can actually present plenty different type of risks that we should be talking about. Rather than listing the name of the risks, I think what I would mention is the question that we should be asking about yourself as to who is our client, who are we dealing with? Okay, what is the client does? What's the nature of business? What's the nature of activity? We need to understand when we perform a customer risk assessment. Where do they do business? Where do they generate the revenue from? That is a very important information that we should have about our clients. How do they generate the money? Okay, that was the where, and then now how. What is the core activities? We should be talking about, so why do they want to do business with us? Okay, why not with someone else? Is there any particular reason? Do we offer something special that a client want to benefit from our products and services, for example? And whether there is any negative news, any political relationship, any sanction exposure. So basically, in my opinion, a client risk assessment is all about asking ourselves some questions: who our client is and what do we do with our client. Okay. There's a heightened regulatory focus right now from all over the world. Governments, regulators, and also the media as well. We've seen a lot of we've seen the Panama leaks, we've seen the WikiLeaks, we've seen the Paradise Papers. So there is media has come up as a very strong stakeholder in the financial services industry. And also one important thing that is coming up now is the senior management accountability. Previously, what management used to do, make a mistake, being lax, not being very vigilant. If there is a fine from the regulator, okay, that's fine. The firm will pay the fine and they will move on. But things are changing now. Now the senior management, they are being held responsible and accountable. Okay, you can't walk away and say, hey, I did not know. I was a senior manager, but I did not know that my CRA didn't work. Okay, well, you are a senior management manager, you should know whether it works or not. That is your responsibility. So this is the tone that we are seeing from the regulators now. So you cannot walk away and say, I didn't know. Okay, so there is expectation that every senior management manager, they should know their roles and responsibilities, their business profile, their products and services, and everything. Right? And if they fail to do so, the consequences could not only be on an organizational level, but also on the personal level as well. Okay, and also there is a I would say is a big social perspective as well. Okay, failing to prevent financial crime that impact lives, that impacts us, all of us. Organized crime, fraud happen, and the tax evasion, human trafficking, all of these type of financial crime. At the end of the day, if we are unable to detect and spot them, they impact us as an individual, as a member of the society as well. The one example, recent one, Standard Chartered hit with a huge fine over financial crime issue. One thing that has been picked up specifically by the regulators here is that their controls when it comes to customer due diligence wasn't good enough. Okay, I've highlighted it here as well. So the fines could be massive. The bank will pay $497 million. It's not that time and age where it used to be $50,000 or $100,000. The things are changing in a very fast pace now. From the thousands to hundreds of thousands. Now the fines are going into millions. So we've got to be very careful. It's better to invest 100,000 and prevent a million or 10 million fine, I would say. Briefly talking about the risk pillars, what I think we can actually split our overall risk rating methodology into two main things. One, the primary risk pillars are those which are common for every client. They exist for every type of client relationship. The secondary one, they change from client to client. For example, a client itself, how long, for example, a client has been incorporated doing business. So every counterparty, every client would have been incorporated. They would have their own history. So that is a unique thing that is or should be available for every client. Country risk, every client is going to be incorporated in a particular country, or they must be operating in a particular country. So country risk is something that you cannot say that for one particular client, a country risk does not exist. That it will always exist. I call it as a primary risk pillar. Industry risk, at the end of the day, whatever part of industry we are, a client will be part of it. Similarly, product risk. Product, it will be part and parcel of every client relationship. Whereas some of the primary, secondary risk pillars where I classify as PEP, a client may have a PEP or may not have a PEP. Okay, so this is secondary, which will differ from client to client. Negative news, sanctions, bribery and corruption. So some things which I call them as a primary risk, which must be part and parcel of every client, which must be associated with every client. Secondary risk may or may not, but that doesn't mean that we do not need to assess the secondary risk. We need to make sure that we identify where they exist and we take appropriate actions where necessary. Let's briefly talk about a good methodology and a bad methodology. My experience, years of experience, a good methodology, it will be automated, standardized, it will be suitable for your own business needs. It will be comprehensive, capturing from the risk from different angles. It will be smart. I will talk about smart in a minute. What do we really mean by a smart methodology? In bad methodology, if you get it wrong, okay, if you get your customer risk rating wrong, you will apply incorrect level of due diligence. If you apply incorrect level of due diligence, you will be asking for incorrect level of verification and ID and V. You will be applying incorrect transaction monitoring rules for a client. If a client should be treated as a high risk, but you have treated as a low risk, you may not apply the required level of transaction monitoring, or vice versa. Similarly, you will be ending up in applying the incorrect risk cycle, review cycle as well, if you if your methodology has produced an incorrect risk rating for your client. Here is a very brief snapshot of a risk calculator that I would like to show you today as well, as to how does it work. Some of the features are here that you can see. We have incorporated the key features like how long a client has been in the business, which country they are incorporated, which country are they operating from, type of entity, industry, product, PEP, negative news, ownership, bearer. We will talk about it in the demo that when we will provide shortly. This is something for you to take away. As I mentioned, that I will share this and all of the slide deck as well. So you will have the information about what are the key features that are part and parcel of the methodology that we are going to show you today. Also, if you're building one at your own, on your own firm, these are the things that you may want to consider to make sure that they are part and parcel of the methodology that you have built in your risk-taking methodology. For example, country, industry, product, negative news, etc. Okay, I will wrap up now. So then before jumping on to the demo, just wanted to mention, if anyone, because this is something that we have actually worked with MFSA as well, we do assist organizations understanding the client risk assessment, how to perform a client risk assessment. So there is, from Sigma Risk perspective, we do offer a risk assessment masterclass. It's a day-long masterclass where we talk about different types of risk, how to build a methodology, how to perform a risk assessment, and what should be mindful about, what to avoid, and what to do. So it's literally a day full of interaction and engagement, where we assist the industry understanding as to what a good customer risk assessment looks like and what we should be doing or not doing. Okay, one thing that I promised to all of you was that anyone who will actually attend today's webinar, we will actually share some great news with you as well. So as I mentioned, that Sigma Risk, we are actually partner of ICA, International Compliance Association, as well in Malta. Also, we are partner of Malta Association of Compliance Officers. So anyone who might be interested in getting a professional qualification from ICA, please feel free to get in touch with me. And another promise that I made to you is that for everyone who is going to attend today's webinar, they will be eligible for special discounts on ICA qualification in Malta. For example, these are the actual ICA prices for different level of qualifications. And here are the webinar prices that you can see that there is a significant discount that we have secured with ICA to offer as a gesture of goodwill to all of the members who are actually attending today's webinar with us. Okay, so before we can move on to Q&A, let me present a very brief demo of a risk rating methodology which we have devised. and then we will actually any question that you have, then we will definitely take it on board. So I will try to be as brief as possible. Let me actually share my screen now. Just give me 1 second. Okay, so can you see my screen? If one of you please confirm. Okay, brilliant. So so this is actually one just for you to give an example as to how does a risk rating methodology may look like. So what we have done, we have actually for everything that we discussed by Kurt and Eric and Stefan and myself, we put it into a methodology, making sure it looks very simple, it appears very simple. It is very complicated in the background, but that is actually, I would say, the whole purpose, that to make it as simple and user friendly for everyone if they want to use a methodology. One thing that what we do, as we mentioned, that one feature that for this particular methodology that we have is, for example, if you have a client, say Sigma Risk, if I enter the name of Sigma Risk here, if you hover over the I button information, you will see that there is no, it tells me an indication is automated, is linked with the different databases. It tells me there is no match on OFAC sanction list for Sigma Risk, for example. Whereas if I enter another firm, for example, Ansar Bank, if I enter name Ansar Bank, you see the inf I box that actually turns red, and it tells you in the live mode that Ansar Bank brokerage company is actually there is a match on the OFAC sanction list as well. So that's one of the clue that we are giving, is that your methodology, as soon as you feed it some information, it is reflective, it is mobile, it's agile, it tells you information. So this is just one thing that I wanted to highlight here. One thing that we mentioned, that we need to know how long a client has been incorporated. For example, if we say there is a client which incorporated like 2 weeks ago, just for an example, you will see the risk bar for that particular client has moved to the right, because that particular risk factor from an incorporation perspective, that's a higher risk, because we don't have any on audited financials or a client history or bank statements, because the client has only been incorporated 2 weeks ago. So there is a heightened risk here in that particular scenario, but you will not see that that particular factor has not really kind of manipulated the overall risk of the client. It just moved the gauge a little bit. Similarly, for example, if you say the client was incorporated, say in Malta, simple example, if I press in Malta, you see the risk of the Malta has gone pretty much to the medium to high. Why has it gone medium to high? If you hover over the information box, you can see that actually currently the Malta rating by Transparency International as of right now is 58 out of 180, whereas 1 mean the least corrupt country and 180 mean the most corrupt country. Although we're doing well, but in Malta we're not doing pretty well. Okay, so we are pretty much in the median, I would say. So from the bribery and corruption perspective, the risk exists. Also, you will see that Malta is actually including on the FATF of grey list. Okay, that is another thing that the firms should be thinking about when we are dealing with some countries. So, but again, you will see the overall risk hasn't really moved up, because in being incorporated in a particular country is one thing, but the real thing is that where are you really generating your revenue from? That is the thing. It's so easy. Like in the UK, anyone from anywhere in the world can pay £13 and open a company in UK. Okay, they might be generating their money, their funds from somewhere else. They might be doing business somewhere else, but just for incorporation perspective, it literally costs £13 and they take 24 hours. Okay, so easy. So let's not be just carried away that a firm is incorporated in a low risk country. We need to understand where are they generating their money from, their revenue from. Important to understand from your client as to where are they generating the money, where are they operating. For example, if they operate generate all of their revenue, 100% of the revenue from Malta. Okay, so now one important point here is that because you are incorporated in Malta, but you're generating everything from Malta, you should be considered as a local firm. You shouldn't be treated as a foreign firm. So you will tick the box as a locally present. It means that your risk, because you are incorporated in Malta and you are doing your business in Malta, from a country risk perspective, it's not a big issue. Okay, so because you know the regulation, you know the culture, you know the financial system, you know everything. Whereas I would say if you were generating 50% revenue from Malta, and if you are generating from 50% revenue from, say Angola, for example, okay, and you are not physically present in Angola, you will see the overall risk has moved up. You're not physically present in Angola, you're generating a lot of revenue from Angola. This is something that we should be, your methodology, it should not be rigid, it should be smart, it should take into consideration the risk from every possible angle. Type of entity, for example, what type of entity it is? It is, for example, a regulated financial institution. Okay, fine, not much risk when it comes to regulated financial institution. Important question is that where are they regulated? If they are regulated, say in Aruba, okay, I don't really call Aruba as an equivalent country. Just being regulated doesn't mean you're a low risk. Okay, yeah, but if you are regulated, say, for example, if you're regulated in Australia, yeah, you'll see the risk comes down, because we consider Australia to be an equivalent country from money laundering, credit financing, and a governance and control perspective. Okay, industry as well. What kind of industry our client is? If our client is from, say oil and gas, for example, if they manufacture of essential oil, you'll see, a move a little bit. If we talk about mining, so deep coal mining, for example, you can go, the risk has gone a little bit higher. Okay, it really depends what is your industry. So what is important here to understand is that every risk factor has their own role to play in the overall risk profile of the client. Not one thing should dictate or manipulate the overall risk profile of a client. Product is very important. Okay, if you are offering a product, for example, foreign exchange, so the funds are already in a bank account, you're converting them from, say, euros to US dollars. Okay, you add a product, you will see not much happen. So here, by the way, you can get different information on the information box as well as to why is it important to know your client's products as well. But here, for example, if you add another product, for example, trade finance, Kurt mentioned trade finance, you add trade finance, you'll see the risk shoots up, because it takes into consideration that we are offering a high risk product to a client, and the client is actually generating half of the revenue from a very high risk country. Imagine if that country if the Angola was out of the picture and you were doing business in Austria, you see the risk has gone down. Okay, so although the product is the same, you change the country, the risk profile change. If the country is the same, you change the industry, the risk profile change. It should be reflective. It should really make you, any change you make, it should go downstream and have an impact. Okay, PEP as well. So politically exposed individual. Here you can get some information about the PEPs. Why do we need to be talking about the PEPs? But again, if you have no PEP at all, of course, you see there's not much rating has changed. But if you have identified that the politically exposed individual in the control structure who is actually a director of a state or enterprise, it carries a different type of risk. But if you see there is a PEP who is the ultimate beneficial owner, you'll see the risk has gone further up. He entered into the red zone. Okay, let's for the purpose of this demo, let me take this away. Negative news. What kind of negative news do you have? No negative news, no risk. Right? If you have a negative news which is material, which is proven and settled, you see the risk has gone up. Settled mean it might be historical negative news. You can only settle a negative news once you paid the fine, you have take the corrective measures. For example, you agreed the penalties, you upgrade your systems and control, etc. But if there is another negative news, for example, which is under investigation, okay, you'll see the risk will go even further high up. All right, so the risk should be reflective, it should be holistic, it should take into consideration the overall risk profile of the client. Not one thing should dominate. Okay, it should be automated, but it should also make sure that it works for you. Layers of ownership. Okay, 5 or more layers of ownership, you'll see the risk has gone up. It start getting opaque, it start getting non-transparent. For example, if you have too many layers of ownership, there is a risk, but that doesn't mean that it drives the overall risk profile, but it does contribute to the overall risk of a client profile. Do they offer bearer or nominee shares? I think if you say yes, you should go straight to the right. Okay, because these are the most loved one scenario from the criminal perspective. If you have bearer shares, whoever is holding these shares, they're the owner. Okay, you can sell it to the criminal and the criminal become owner of the firm. Okay, so not many countries offer that anymore, but I know there are still a few countries who permit issuance of the bearer shares. UBOs, ultimate beneficial owners, who are the people who actually control a firm. For example, you have one UBO from Austria, you add it, doesn't add much of the risk. For example, if you had two UBOs, one was from Azerbaijan, you add it, boom. You see, it reflects on your overall risk profile. The risk moves. You have, for example, another UBO from Russia, you add it, the risk moves further as well. Okay, the higher your UBOs from different countries, they bring the respective risk as well. You take a UBO away, the risk moves back. So this is what we meant, that some idea for every one of you to think about it. Okay, if we are building a methodology, if we are talking about building a solution for ourselves, it need to be responsive. It need to do justice with our risk exposure. It should be aligned with our risk appetite. It should be aligned with our product and services, etc. It should take into consideration every possible risk angle, and it should take the stress away from the senior management. Okay, so here, for example, the day, for example, Malta was added into the gray list, this system was updated straight away. So nobody had to update the country list. Nobody had to talk to the IT. Nobody had to send a long, IT job reference forms for them to go and update their methodology. It works in live mode. It's connected with the APIs, with the information sources. Okay, this is all from my end. So just the purpose of this exercise was to share with all of you our expertise or our ideas as to what may be a solution that you might want to build in-house, or if you want to buying something from the third party, what you should be talking about, what should you be thinking about when it comes to building a risk rating methodology. So that is all from my end. So we have 4 more minutes. If anyone's got any question, please feel free to add in the chat box. In the meantime, I will request Stefan, Eric, Kurt, if you have any comment, please feel free to share your comments.
Okay, well, from my end, as I said, this is a live process. So let's make sure that when touching on CRAs, we need to revisit them, make sure that they are still relevant, that we are pinging them with more information as we go along with our customers. So it's not just a one exercise we did 3 years ago and we stopped there. The law as it is, and as it's going to change, requires us to do more. It expects us to be more proactive. So we need to substantiate our proactivity.
Thank you, Stefan. Any last comment from you, Kurt?
No, I agree. I agree with Stefan. Is that the CRA needs to be kept updated on an ongoing basis. With every review, the ideal situation is that the customer risk assessment is updated.
Thank you, Kurt. And Eric, any last comment from yourself?
Yes. Perhaps another point which is equally important, I think, is the adequate rating of the risk factors being taken into account in the customer risk assessment. I think, especially when we see examples from the industry, when we have risk factors being weighted incorrectly, it totally skews the ultimate risk rating. And I think it's an important point that each subject person remains aware of.
Thank you, Eric. This is absolutely amazing session. I really thoroughly enjoyed myself. I really learned myself as well. So very huge thank to Kurt, Eric, Stefan for coming and presenting, and thank you for all of the delegates who actually attended today. So we had actually quite a healthy attendance today. So at a time, I think we had 74 members who were in the session. So it's a very, very good turnout. I'm very pleased, and we will come back and we will hold another session another 3 months time. So if anyone has any suggestion about as to what is the next topic you want us to share and discuss with all of you, please feel free to drop me a line. So what I will do at the end of this presentation, maybe later tonight, I will share the copy of the presentation with all of you. And should anyone need any information or assistance from our side at all, please feel free to reach out to myself or Stefan or Kurt, and then we should be very pleased to offer our assistance. That is our motivation and dedication, that we offer assistance and service to the Maltese compliance community. Thank you very much, all of you, and hope to see you soon.
Thank you. Thank you. Good evening.
Thank you.
Thank you.
Thank you.